you very much for being here. I will bring you the Cartesian side of the story. Just a very brief word of introduction on what I do. Analysts in the financial services world study sectors and produce research and then consult and advise investors, the people that manage our savings, the banks, the insurance companies, the pension funds, on what stocks to buy and what stocks to sell. Today I'm going to talk to you about luxury goods and growth and bring you the logic of why it makes sense for luxury goods companies to engage even more in digital and e-commerce. So if I manage to get this thing to work, yes, there we go. Growth is central for the luxury goods stocks. What you see in this chart is that luxury goods stocks, by and large, trade on growth expectations. On the horizontal axis, you see what growth expectations the market is having for the next 2 years and how the multiple for these companies, I'm showing you here, the large caps in the sector, companies like LVMH, like Kering, Swatch, Richemont, and so on, trade in terms of multiple to their earnings. So it's very important to maintain growth. If we look where growth has come in the most recent 8 years, we find two very important areas. This is the luxury goods market in 2005, 147 billion euros, that's defined by Alta Gamma. And in 2013, this grew to 217. You see very clearly that there were two elements providing the bulk of the growth: pricing, i.e. price increases, and new retail space, new stores. Now, when we move forward, we see that a lot of that growth has actually come on the back of emerging markets consumers. This market, this sector, has become a proxy for investing in emerging markets, in fact. You see, most importantly, that the Chinese in the past 10 years have grown from virtually nothing, 1% of consumption in 2002, to about a third, or to about 30% in 2013, and a third in the expectations for 2014. So a major driver and a major boost to this industry growth has been the development of wealth in China. When we look forward and anticipate what is going to come in the future, we see that growth is becoming and will become more difficult to achieve. The first reason is that the Chinese economy is growing at a more moderate rate. GDP in China has been growing in the past 10 years at more than 10%. Growth expectations in China moderated to 6 or 7%. And as you see, as GDP growth has moderated, the number of new wealthy people that the Chinese economy is producing has also moderated. What you see in this chart is that, for example, the affluent consumers, as defined as households making between 75,000 euros and 15,000 euros per year, the newly created affluent households have gone from 6 million to about 3 million as GDP growth was moderating between 2010 and 2011. The other reason why growth is going to be more difficult to achieve is that the bulk of the new store development has been achieved. And what you see here is based on our retail database. On the left-hand side of this chart, we show you GDP per capita on the horizontal axis, and on the vertical axis, we show you the luxury goods stores per million inhabitants. And what you see is that China is already very significantly above the regression line. And invariably, when we speak to luxury goods companies, they're all putting the foot on the brake as far as opening new stores in that market. And you see that Greater China, on the right-hand side, is now the second largest market after the United States in terms of the total number of stores. And this is, again, from our database. It's not all of the luxury goods stores. It's just stores from about 33 brands that we have benchmarked all around the world. The other development that we've seen in the most recent 10 or 15 years is that luxury goods companies have transformed into retail companies. And as they did that, they capture a very significant amount of the value added that was previously left to the wholesale channel. Now, what this chart is showing is that some of these companies and some of these brands have already turned into retailers outright. So even this side is maxed out, at least in the soft luxury space. You see that brands like Prada, that used to be just a few years ago relying 50% on wholesale, today are actually, in that chart, we show them as being around 80%. Today, they're more than 90% engaged into retail. So that growth driver is maxed out, at least for the soft luxury companies, less so for the companies like Swatch and Richemont. These are the forecasts that we have produced with Armando Branchini and Alta Gamma. And this is one of the major reasons why we think that online and e-commerce is not just a matter of if for the large luxury goods companies, but a matter of when. And the reason is that a lot of the growth that we're going to be seeing in these next few years, if you assume that the market will grow at 5%, we see that the online luxury is going to produce a very significant contribution to that growth, and alone is going to provide between a fourth and a third of the total market growth. This is not just going to be growth, but it's going to be high quality growth. Return on invested capital will be boosted by incumbents moving into online and e-commerce. The reason is that they can piggyback on existing assets, so the amount of investments that they have to commit in order to get online and in order to develop their e-commerce operations is very minimal, because they already have brand awareness and trust, they already have a physical retail network, they have logistics flows and infrastructure that they can use for online operations as well, and they have in-store sales personnel for cross-channel activities. And the online sales of incumbents are going to be coming at a higher margin because they will not carry rental costs, and they will replace front office personnel with back office personnel. And the delivery costs of luxury goods, considering the ticket size, the average ticket purchase that the consumers commit, is going to be relatively immaterial. Return on invested capital is the key for investors, so I think that companies engaging in e-commerce and online not only will be doing a favor to themselves, but they will also excite investors, as we show very clearly that over the long term, improvements in return on invested capital, as we show in the past 10 years on the x-axis, on the horizontal axis, correlate with superior total shareholder return. Total shareholder return is the sum of dividends and share price appreciation. So e-commerce is going to be providing growth. It is going to be providing high quality growth. The way to go, we think, is that of integrating e-commerce and digital with the physical distribution activity. There are two major reasons for this. First, on the right-hand side, consumers want that. And you see that there's just a minority of consumers that just engage in e-commerce transactions with luxury goods companies. Most of the consumers want to research online and pick up in store, want to make the most of their interaction with the brands. And on the left-hand side, we show in fact that cross-channel clients are basically worth twice as much as the physical retail-only clients in terms of purchases per year, and 3 times more than the e-commerce-only clients. So cross-channel and integration of e-commerce and physical distribution is going to be the way to go. Luxury brands and luxury companies have accumulated a very significant delay, but this, I think, could be excused at a time when priorities were driving them to other opportunities, opening stores worldwide and so on. But most of what you find here is not really a concern anymore. And just to be very short, again, we think the path is set for digital engagement by large incumbents in luxury goods. They have wasted time. Luxury goods players, you could say, have wasted time. Most of them are still beginning in this area, although you have a number of notable exceptions, like Burberry, for example, followed closely by Richemont. But they haven't wasted opportunity. The market is still there for them to capture. This is going to provide high quality growth and major shareholder value creation opportunities that I was showing before, as well as better sales effectiveness. Engagement in e-commerce and online will provide luxury goods companies with a real opportunity to open a dialogue, a one-to-one dialogue with their customers. Today, most of the media dollars that luxury goods companies commit are on mass media, which is not particularly efficient when you consider that it's just a minority of people buying luxury goods. So that's it. Thank you very much.
We don't have many times for questions because we have a lot of speakers and some of them are only speaking for 10 minutes. But I just want to ask one question. What are the publicly traded companies doing about the startups that are going from 0 to 20 million revenue in 6 years' time? Are they scared? Are they wanting to buy these startups? What is their approach to this new landscape?
I don't think that they are scared. I think that the best large incumbents are watching them and trying to get lessons for their core businesses. If you think about Richemont, for example, buying Net-a-Porter, I think that was instrumental for them to touch with their hands the actual opportunity that comes from online and e-commerce engagement and transfer that know-how and experience into the core business of Cartier and Montblanc, for example.
Brilliant, interesting. Thank you very much.
Thank you.
All right.